Did you know that if your tax bill is over £1,000 for the first time, you're going to have to be paying 150% of your tax bill on the first payment? This is called HMRC's payment on account, and I'm going to explain it to you. When you're employed, you get paid monthly or weekly or bi-weekly, whatever it is. HMRC get your tax money immediately, that month, that week, that bi-week, whatever it is. When you're self-employed, you almost go 365 days without paying any tax. This is the reason why HMRC have created the payment on account scheme. And it's basically to get the money quicker into their bank account from when you originally make it. Payment on account is a way of HMRC splitting your tax bill into two. So you actually pay at 2 times throughout the year. The first time you might be aware of is January 31st. The second time is the 31st of July. But here's the kicker. The first time you make a payment on account, you might be in for a surprise. You don't just pay for the year just gone, you actually pay an extra 50% on top. This is your first payment on account. This extra payment is for the following tax year, which hasn't been filed yet, and is based on an estimate of your last tax year. You'll then pay an extra 50% the following 31st of July. So in summary, you start from April round to March. The following January 31st will be your first filing and payment deadline, where you'll pay an extra 50% of your bill. The following July 31st, you'll pay an extra 50%. What this means is if you have a tax bill of £2,000, by the 31st of January, that particular year, you're going to be paying £3,000. And then the following July 31st, you're going to be paying £1,000. That extra £1,000 in January and the extra £1,000 in July is your payment on account. And that will be deducted from the following year's taxes. So the following year, because you've already paid £2,000, if your bill is exactly the same, which is £2,000, you will pay £1,000 in January and £1,000 in July. Why do they estimate it? They estimate it because they assume that you're going to earn roughly the same amount next year as you have this year. However, if you do think you're going to be earning less next year, then you can talk to HMRC and they can reduce the payment on account for you. In the long run, it's actually going to make it easier for you to pay your tax, as you pay it closer to the time you earn it. A top tip from Blue Rocket Accounting is whenever you earn income for your business, put a percentage of that income away into a high interest savings account so that when you get your tax bill, you know you always have enough money to pay it. If you want more information about self-assessments or about payment on accounts, please visit bluerocketaccounting.com.